In terms of deal flow, we just were bombarded last year, right? Which is interesting.
With the decline in interest rates and what occurred with the Fed and the government and everything, there was a tremendous amount of capital that flooded into the markets. And so what we're seeing was deal flow shut down and everybody was waiting for opportunities. And then the Fed flooded the market. And so now what we see is really, really high valuations. People not diligencing deals. I mean, it's unbelievable how quickly deals are closing and transactions are getting done, and we may go in and start to do our due diligence, and then all of a sudden a company will do an exclusive with another company, and then they end up paying a very high price for these assets. So we see valuations really, really high right now. And we're hopeful that the correction in the equity markets are going to bring valuation multiples down and expectations down. So, things were high. The market was relatively fairly valued when the pandemic hit, and now I think the markets have been overvalued by virtue of the Fed and all these private equity funds.
So like 2019, all of us in the deal business were on this high-speed train, and then as Beth said, 2020 Q2, conductor slams on the brakes and deal business stops. But in 2021, as Beth said, so much PE money out there that they have to invest, otherwise send it back to the LPs. And publicly traded companies looking to grow can't do it organically. Let me buy a company. I think you're going to see a continuation of what we call the gray tsunami. All the business owners, 50s, 60s, 70s, looking to retire and cash out. I think you're going to continue to see more and more money being put into private equity. I'm on a couple of endowment funds, and we are all of a sudden now allocating 10, 15% to private equity because the returns have been 15 to 18%. So we're going to have another strong year.
We will see, but I think Steve was right that we're on the precipice of a tremendous transfer of wealth as the boomer generation kind of moves out, and there's not always a great alternative if you don't have an heir or if you don't have somebody that's next in line. There's private equity, there's strategics, but sometimes people have a competitive fire and they don't really want to sell to a strategic. It becomes a very personal thing.
So I, like Seema, think that it's going to continue to be strong. I think there's going to be a lot of deal work. We certainly hope there will be a lot of deal work. I also think that there's going to be a continued sell-off of multi-generational businesses, whether it's parts of the business or the whole. I heard it from a couple panel members here, and Pollads want to put money into those, right? So I think that's going to continue to be strong. I also think that there's going to be a lot of strong growth for those companies who want to put equity infusion into some real strong companies now that just want that to grow. So they're looking at selling minority interests for growth. I do also think, however, that there's going to be supply chain and logistic issues and labor issues that are going to continue to surround certain deals, right, in certain companies. And with those, the deal structure and the due diligence is going to have to be adjusted to reflect those types of issues. But otherwise, I hope it's going to be a strong year.
I think it's going to be a strong year, not like last year. All these funds have raised capital, but interest rates are going to go up. So you're going to see a slowing in activity because of rates going up. Capital is going to be more expensive. I think the other thing we're going to see is returns are going to fall because prices are so high and so many deals are getting done at these ridiculous valuations level that if we look out a couple of years, I just don't think we're going to see the returns from private equity that we started seeing in the past.
No, I don't know. Labor's a real concern. I mean, that's the biggest one that I would have as an operator, as an investor. There's a whole bunch of, it's the return to work thing is still a real hurdle, right? And it's just the shifting dynamic of that power balance going to the employee base. It's going to cost more to staff your organizations. That's a real concern.
Right, inflation is the enemy of the investor, right? Because it eats at your returns. But I think to the extent that you're investing in businesses that can pass that pricing power, the pricing along, right? I don't think there'll be an issue. And I agree with Nathan. The interesting thing is I think the real issue for the economy is not inflation. I can't remember a time when I go to do, you know what, I live in St. Paul and I was out in Wayzata. And I can't remember, I was out in Wayzata and I was driving home and my son said, I wanted Jimmy John's. Do you know that Jimmy John's was closed at 5 o'clock on a Friday night?
Yeah.
In Wayzata? That's where I think we're gonna have problems. Or the Starbucks is closed at 6 o'clock because they can't staff. That, I think, and I keep trying to wrap my head around how that's gonna affect our economy. I'm less concerned about inflation. I'm more concerned about Jimmy John's being closed at 5 o'clock on a Friday night. Starbucks needing to be closed because they can't staff. That's the bigger issue. That's a labor issue.